Okay, we're live. Hello, hey everyone. Good evening, and welcome to another episode of the Ringgit Plus Show Live, a special segment called the Ask the Expert Anything. And this week, I want to introduce you guys to another one of our financial experts, Azril. Hey, good evening, Azril.
Good evening, Pang.
All right. So Azril is another one of our CFPs with Ringgit Plus Advance. He is a CFA, CFP, and also an Islamic financial planner. So he handles most of our Islamic clients as well. So that's pretty cool stuff that he's doing right there. So Azril, I know we've been talking with you guys a lot, and one of the reasons why we're going to come up with this week's episode really comes down to one of the questions that a lot of your clients have been asking, right? Not just with you, and also with Han and Priscilla as well. This past year, 6 to 8 months, has been really difficult for a lot of us. But surprisingly, some of your clients have come up and actually said, like, while earlier this year was really tough. Some of them have recovered their salary. Some of them have found new jobs, which is really good news, right? But what's happening as well is that because of that, they have like a slight amount extra of money every month. They're also spending less because, obviously none of us can go out. Their holiday plans, their holiday budgets have also been, no longer necessary in the last 2 years, basically.
Yeah.
So that's actually a surplus of money, right? So for this group of people, and I would say there's a considerable amount of people with this as well, not just, everyone who's struggling. There is this group as well. And this episode, I just want to cater to this group of people who are asking, how do I kind of have like a little reset button and move and bounce back from whatever that's, the year that's passed? And is there anything that we can do from now until, when our economy eventually recovers and we put ourselves in a much better position than we were before, right? So I know you have like a little presentation that you want to do. So I'm going to give the floor to you. So all the best, and we'll hope you guys enjoy this one.
Thanks, Pang, for that kind introduction. So I'm going to go through a couple of slides, so hopefully over the next 10 to 15 minutes to give a little bit of overview around our thoughts, leadership around the economy and how economy is looking to improve, and ways in which you can future-proof yourself, right? Financially, we can all agree that the past 1.5 year has been challenging financially, right? With continuous lockdown, MCOs that have direct impact on our wealth and income, right? So let's look at how we can future-proof ourselves during this pandemic and hopefully after pandemic. So in terms of financial impact of COVID-19, so we know and we've seen that there has, of course, been an increased unemployment rate from 3.3% in 2019 to 4.5% in 2020. And now we're seeing that increase to 4.5%. So what that means is that, of course, a lot of more people in Malaysia are out of job, right? And means the impact that they would have then subsequently on two areas. So one is depleting cash flow and savings, right? For those that have exhausted their savings during the period and have to take out, for example, loan moratorium as well as EPF withdrawal, right? And also seeing a significant number of Ringgit Plus readers and viewers as well, that there has been a decrease in purchasing power, right? With reduction in salary, potentially, or bonus, and salary not growing fast enough to beat inflation, right? So this has been a rather difficult time for all of us. Although the number of cases per day remain high, looking at the pace of vaccination program as part of the National Recovery Plan, we are somewhat hopefully optimistic, right? That things will get better economically and the worst are behind us. The economy typically are somewhat more resilient, and we are starting to see that happening as well. So we should expect, hopefully 100% of Malaysians to be vaccinated in Klang Valley, Labuan, and Sarawak by August and September, and the remaining of the states to be completed by October or the year end, right? So economically, although things may look very dire, right, in terms of the number of cases that we've seen, we're starting to see some level of recovery, although not to the level that we should expect to, right? In previously, the estimate was that the economy was going to grow at 6%, but we're seeing that projection reduced by the World Bank and Bank Negara to 4.5%. So you may be wondering, right, how this would affect you personally, right? Well, GDP projection can be used as a leading indicator, right, for greater investments, higher business sales, and thus more employment opportunities and therefore income, right? And this is not the first time we've gone through this, right? So if those of you that have remembered, we had 1997 crisis, and we also had 2008 crisis to give a good guidance on the future on what it's going to look like for us. So let's now look at what you can do, right? So there's going to be and typically two types of group of people, right? So one, those that have been a little bit more affected and as a result has less number of savings available today, right? For those group, I would very much suggest that you looked at rebuilding your emergency fund, right? Rebuilding your emergency fund to support any emergency needs that you may have in the future, right? And the first question, and often the frequent question that we get around this is, okay, Azril, you talked about emergency fund. How much should I keep, right, for emergency fund? So typically, we talked about the simple answer to that is 3 to 6 months of your total expenses. So, for example, if you spend 5,000 ringgit per month, that should mean around 30,000 ringgit in terms of emergency fund. So this is the first step. But of course, the long answer to that is, if you do not have any emergency funds yet at this point, then you should look at maybe allocating a couple hundred to at least 1,000. So any amount saved is going to go a long way for you to be able to withstand any emergency needs that you may have. The question that we often get as well is, should I place these investments for emergency in fixed deposit or savings account, right? So the answer to that question is, unfortunately, if you were to put your money in FD or savings account, you may not be able to save yourself from inflation, because what we've seen in this chart is that there has been instances in the past whereby the return from fixed deposit on an average basis has not been able to be higher than inflation. And as a result, what you will get is that your savings in FD will be depleted with higher inflation. So this we can see in a couple of period in this chart, right? We see that within the 2006 period, we see that within the 2016-17 and more so recently. So the next question that you'll be asking is, okay, where should I place my emergency fund, right? So here are some of the principles that we would suggest that people use when it comes to emergency fund, right? When it comes to emergency fund, you need to look at three principles. So the first is to ensure that the investments is not of high volatility, right? Because of the needs that you would have with this emergency fund, you may need to be able to withdraw that within a short-term period of time. So therefore, you should look at putting it into an investment that is not going to be too volatile. And number two, it has to be sufficiently liquid, right? So it means that you need to be able to withdraw when you need it. So within a day is the timeline that you should be looking at. And the third is that it must beat inflation. And what we saw with FD rate is that unfortunately, FD is not going to be able to beat inflation. So what is the alternative, right? And the answer to that is there could be multiple assets that you can consider. And one of them that we like very much is looking at a fixed price unit trust that is offered by ASMB, where you'll be able to achieve all three objectives that we see here. And to illustrate that return over time, here you can see the charts of the multiple fixed price unit trust funds that's offered by ASMB and the returns over time, right? What you see is a consistent return above inflation. And that's one of the key requirements for emergency fund. And that's why we would think that this is an instrument that you should consider. But of course, what you see is also a declining trend, right? So as such, you need to be able to monitor this and look at whether that return would be lower than inflation over time. For those of you that may have a little bit more funds available beyond emergency fund, right? So you have reached that level where you have already adequate amount of savings that you put on emergency fund, then you can look at investments assets that will be able to potentially give you a higher return over time. All right. Here is where you can look at multiple assets, right? So the first and a rather interesting one at this point is the purchase of real estate, right? Here, what we see is that the market is reaching a level of oversupply that we have not seen before, right? We are now at a recorded all-time high surplus of 50,000 units in the year 2020. So for those of you that have been waiting and are looking to get into the property ladder, now is a good time for you to look at undervalued properties that are on offers in the market. So I very much encourage that you take the due process to review these properties. And of course, there's a couple of tips and techniques that you can look at that. One is to ensure that you do not have exposure that is more than 30% of your income into a mortgage. That's one advice that we would give. Number two is that if you're looking at investing for the purpose of investing in properties for investment, then you should look at achieving a Rule 200 in terms of return on rental. So how do you use Rule 200? So if you are able to purchase a property at 500,000 ringgit, then you should be looking at getting a rental that is 500,000 divided by 200 to get a minimum rental rate of 2,500 ringgit. So at the very least, you will get 5 to 6% return over time and are able to support the mortgage payment that you make, as well as other associated costs to owning a property. Assets number two that you should be looking at is buying equities, right? When economy recovers, typically what we see is also the growth of equities market. So this is where it is very important for you to look at investment assets that would be able to provide you sufficient diversification and also exposure in the global market, right? Oftentimes, and I see this all the time with all the clients that we have here at Ringgit Plus, is that majority of Malaysians have 70 to 80%, up to 90% of their assets in Malaysia. So this is a combination of your property, your EPF savings, your FD, as well as your investments in Malaysia. But what we think that you should do as well is to ensure that you have sufficient diversification and investments in the global market, right? So this can be done across multiple areas. One is, of course, direct access to equities, where today, for example, you can create a brokerage account to invest into equities in the global market, such as the US and also China. You can also, of course, buy unit trust funds that invest in global markets, as well as exchange traded funds that are now available with robo advisory platforms that we see licensed by the Securities Commission in the market. And the third is that for those of you that are a little bit more adventurous, you can look at investing into alternative assets. What are these alternative assets? There are a lot of new assets that have been created over the past couple of years as a result of the advent of technology transformation. So here you see a couple of interesting assets such as cryptocurrencies. You can invest into P2P investments, equity crowdfunding, as well as, of course, the old age gold investing. So these are alternative assets that you can also consider. But importantly is to ensure that you invest on things that you know and understand well. And this is an important point because often what we see is that majority of Malaysians and our clients, they tend to invest because they are FOMO, right? Because they have seen that their friends and their families have made a lot of money in this space and decided to invest purely for speculative purposes without really understanding the fundamental value of these assets. Finally, as part of these slides, I wanted to go back to the fundamentals of investing in terms of what is the right allocation that you should look at. Of course, there are plenty assets that you can consider, and we've covered just 3 of them broadly earlier. What you need to look at is using a rule that we would like to introduce called Rule 100. So what is the Rule 100? Rule 100 is a guidance to determine the excess, the amount of allocation that you should make on a growth asset. So, for example, if you're 30 years old, you would use Rule 100 minus 30 years old to be able to get 70% allocation into growth assets. So here, what you see is an example of that, right? So if I'm 30 years old, I should look at exposing and investing into growth assets. That's a total of 70%. So here you see a combination of growth assets plus alternative assets. And the remaining 30% into stable assets and as well as commodities. So for those of you, and majority of you would already be thinking, oh, I have EPF savings. I may also already have investments in ASMB. So this is the allocation that you should put within your 30% here, right? That you see within the stable assets. Then of course, if you're thinking, oh, I want to also invest in gold, then you can allocate maybe up to 10% of your assets in gold. While the remaining amount you can put into growth assets such as equities. You can also include that in properties. And if you want to have exposure in alternative assets, of course, you can also look at that. But we would recommend that you do not look at investing into alternative assets above 10% of your total allocation, because, of course, there is a possibility that these investments might significantly reduce in value over time. And we've seen that within the crypto market, for example, within the quarter one and quarter two this year, where you see significant decline in here. Then the following questions, and I would like to end it with this, is that for those of you that are older, then you may be thinking, okay, how do I use this Rule 100, right? As you get older, then your exposure within the growth assets would reduce, and your exposure within the stable assets would increase over time. And that's how you should balance that. And look at the growth. And in totality, I should suggest that everyone do this at this point or at the start of the year and review your allocation and adjust accordingly based on this Rule 100. That's all for me. Thank you. Let me pass the screen back to Pam. Thank you.
All right, thanks, Azril. Wow, that was honestly, we go through the slides before the show, and some of these stuff actually is pretty eye-opening because a lot of times I think it's hard to get yourself out of the doom and gloom of what's happening right now, and it's always nice to kind of see some fresh perspective of let's look forward to what we can do right now to help ourselves in the future, right? So yeah, thanks, Azril. So now we have quite a bit of time. I just want to say thanks to everyone who has sent their questions over on Slido this week. We got a lot more questions than before, so we'll try and cover them as much as possible. So I'm just going to go straight into the first one, yeah? Hello, I withdrew from my EPF earlier this year, but now that my income has recovered, should I put the extra funds back to EPF or to a higher risk investment? Good question.
So if you do now have extra funds, I would very much encourage that you looked at topping up that funds again to the level in which you had withdrawn in the past. Right, the goal of savings in EPF ultimately is for the purpose of retirement. Right, and generally the allocation should be as per what I've stated earlier, which is a percentage of your age. Right, so if you're 40 years old, then you should look at putting into safe investments, of which EPF is one of them. So in terms of the allocation, you may be thinking, okay, should I put into EPF? Yes, I would encourage that you do that. And not many people know this. Actually, you can put back into EPF up to 60,000 per year, so approximately around 5,000 a month if you want to. And if you are a little bit more adventurous and looking at generating higher return, then yes, you can look at investing into higher risk investments. And in my mind, typically these higher risk investments would do better when the economy recovers, right? So when we talked about equity prices, we talked about crypto prices, typically that commensurate or have a high positive correlation with the economy. So we should expect that to be the case as the economy recovers. Because ultimately, what is a stock price, right? A stock price is a reflection of how the company is doing, right? And as the economy is doing well, then the company will produce better numbers, and therefore the price should reflect higher.
Right. So again, I think that the summary of that question is yes, but it all depends on your individual risk appetite, whether you want to put it in a safe asset or something more adventurous, right? Cool. Next one. What are the considerations in strategizing the allocation for my investment portfolio? So percentage of equities, fixed income, and alternative investments. So I think you covered that in your slides, but we'll run through it again.
Sure. I think the question specifically maybe is to look at the three different asset classes. So the first is equities, right? So the percentage of equities here is reflected as per the growth assets, right? So the second end that we saw here, fixed income, we would allocate that as part of the stable assets. And finally, I think the third is alternative, right? Alternatives is at the top, is the 10% allocation. So of course, this is a rule of thumb, and I'm not saying that this is exactly the amount that you should put over time. For those of you that think they're a little bit more aggressive, then of course you can put more allocation on alternative, for example. But the idea here is that as your age increases, therefore your risk appetite should reduce over time, because then when you reach the level in which you need the funds, which is at the point of retirement, you want to ensure that you don't have overexposure into risky assets and have more exposure into stable assets that are able to give you consistent return over time for your retirement needs.
Cool. All right. That's a strong answer. All right. Next one. What would you advise to hold monies in multiple currencies? Yeah.
That's a good question. Yeah. I would certainly encourage that people do this if you have multiple exposures in other countries in terms of the investments. So in an instance whereby, for example, you, for example, have multiple assets across the globe, multiple, for example, houses, then it makes sense for you to have multiple exposure because of the volatility of risk between multiple currencies, and you can use that as a way to hedge your exposure. So that's one way in which you can do it. But oftentimes, majority of Malaysians, a majority of clients that come to Ringgit Plus, this is not the case. So therefore, you are not necessarily required to have multiple currencies. In fact, it may not be a good position for you because you are susceptible to this volatility that might not be in line with your own financial position. And often, majority of Malaysians do not need to have this unless, of course, you have multiple exposure in assets. That's number one. Number two, activities in terms of spending, right? So if you, for example, live 3 months within in a specific country because of whatever reason, right? You have kids living there, or you may be having business operations there, then it makes sense. But majority of Malaysians should not have these kind of multiple currencies unless there's a specific purpose to it. So the short answer to it must be purposeful, right? And you should not just be holding multiple currencies unless you have a specific view. For example, you have a view that USD is going to be rallying, so therefore it makes sense for you to have exposure in USD. But oftentimes that kind of view is not oftentimes on individual basis.
Right. Because your exposure could also be in equities as well, right? So you would have
absolutely right. So effectively, if you have exposure into, for example, a US stock, so therefore,
correct.
Effectively, you are having exposure into US currency.
Okay, cool. Let's go for the next question. If I want to put extra cash for retirement, either in PRS or KWSP, but also invest in equities at the same time, what's a good ratio? So yeah, they come down again to that your little slide that was really important.
yeah, I think that could be a golden sort of ratio that everyone could guide themselves to, and that's why I'm glad that I have these slides for the purpose of today's discussion. So very much. So I think depending on your also your financial objectives, and this is important, right? So for example, if you have a financial objectives of achieving X amount in a year at the point of retirement, for example, then you should look at what is the allocation and the expected return from all these assets. So for example, if I want to have $1 million in 20 years time, an allocation that you should look at is an investment, for example, of 1,500 ringgit per month with 9% return to be able to get to $1 million. There's a rule around this. We call it here at Ringgit Plus rule 50-20. So if you want to have $1 million ringgit, for example, you could have savings of 50 ringgit per day or 1,500 per month. and invest into 9% return to get 1 million ringgit within 20 years. So that kind of rule, for example, would guide you to a specific return of 9%. So if you are looking at investing, then you can say, okay, I should look at investing maybe 50% of that in investments that can make substantially higher return than 9%, for example, at 13%, while the remaining 50% on 6% return that you should get from EPF. So it's very much driven by the objectives and the goals that you should have. And I will use as a guide to be able to determine how much allocation you should make beyond the rule 100 that I've just spoken earlier.
Yeah, that sounds really complicated, and yeah, I know, but this is what you get from a financial planner who will be able to give you, a really big sense of an individual's different ways of investing based on that person's needs, right? Okay, cool. We'll go for the next one. Why would you prioritize real estate investments over equities when historical returns coupled liquidity issues, equities trump over real estate?
It's a good question, and I think this goes to the fundamentals and the features of these two investment assets. So one thing that one should look at when it comes to these two assets is to look at a couple of key things. So I would use a framework around return, liquidity, costs, as well as time horizon. Right? So these are the 5 key characteristics that I use when evaluating different assets. So when it comes to return, for example, yes, you're absolutely right. Right? Historically, the return of equities is higher than real estate on an absolute basis. So in the instance whereby you put the same amount of cash over time, what would be different for real estate is the ability to take leverage. And this is a key fundamental difference to real estate, where, for example, you can borrow from a bank to invest to generate higher return over time. So this is something that is absolutely very different. And from that perspective, real estate can actually be better than equities if you invest in the right real estate that will be able to generate positive return that is of multiplier, right? So because, for example, when you look at buying 500,000 in properties, 90% of them can be in debt financing, right? Which means effectively you only need to put 50,000, where the return, for example, is 5% of that 500,000 will be a multiplier of that, because the only capital that you need to put is 50,000 versus, for example, putting that same 50,000 in equities. So in that aspect, then of course real estate can be better than equities in terms of return. But then there's also, of course, a consideration of liquidity. And this is one of the 5 criteria that we talked about. Liquidity, of course, equities has better liquidity compared to real estate, given the time taken for you to liquidate properties, right? It takes 3 to 6 months, for example, for you to buy and sell property, and that takes time, right? So that can be an issue when it comes to investing in property. So I would look at it in totality among all these 5 criteria, and we haven't even talked about cost. For example, buying properties has a lot of associated costs beyond versus equities. For example, the purchase cost, right? At the point when you buy a property, there's a lot of associated costs, right? Legal fees that you have to pay on multiple agreements that you have to sign, stamp duty, and multiple others, which the cost like assessment tax, quick rent, a maintenance fee, all sorts of things that goes into buying a property. So I would look at it in totality in terms of net return, and you should make a comparison on a net return perspective, taking into account all these other factors as well, such as liquidity, such as cost, such as time horizon, and your own investment objective. That is, I think those are important.
Right. So that's a really passionate answer for this topic, and I feel like you've made this debate before in the past, but again, this is the kind of comprehensive responses that you're gonna get from a CFP, right? So for your clients, I'm sure they're really lucky. Our producer also cannot tahan, put the next question up already. So we'll go for the next question, okay, Azril? Let's go. What is the next best options if I want to put my extra fund if I already have some fund in ASB? Let's assume that they maxed out their ASBs, right? Is it robo-advisor, or maybe or you can top up more ASB?
Yeah, I think certainly, right. I think maybe I would categorize that based on 2 buckets, right? When it comes to investments, I would actually look at it depending on the objective that you wanted to achieve. right? And the bucket I looked at is bucket for short-term investments. If you're looking at investing for a period of 12 months to 5 years versus if you're looking at investing beyond 5 years until 20, 30 years. The characteristics of that investment asset has to be different, right?
Yep.
If you're looking at investing for the purpose of a short term, then I would advise taking on an investment that into assets that has lower volatility, and effectively ASB provides a zero volatility effectively, because the price remains at 1 ringgit and that never changes, right? And the only thing that changes is, of course, the dividend that you get. So effectively, you can use that short-term investment objective. For example, you want to buy a car, if you want to buy a house, you can use that funds to be able to invest and be able to generate consistent return within a short period of time, because you need these funds and these at the point when you need to achieve this objective, right?
Right.
But if you're able to say invest and wait for more than 5 years, then actually you can invest in something that gives you higher return than ASB. ASB gives a return that is 5 to 6%, but there were a time, of course, when the returns were 8 to 9%, but not anymore. Then if you looked at investing into two types of asset classes, so one that we looked at is a passive exchange traded funds investment that can give a return that is more than 9 to 10%. Another is a growth unit trust funds that can also give you 8 to 9%. That makes your money work harder for you, and that is the objective here, to ensure that you can also make more money with that. So to answer your question, yes, robo advisor is one of them, and you can use that to generate a higher return beyond ASB.
Cool. All right. So for the next stocks, next question: are growth stocks still considered undervalued assets today? So part of your question just now, for your slides just now.
Well, glove stocks, of course, have taken quite a little bit of beating, right? Following the increase in vaccination across multiple countries, and therefore a reduction in demand for gloves. And as a result, you see the significant decline in glove stocks across all the glove companies. So to a certain extent, I wouldn't say that all glove stocks are undervalued. This assessment would have to be taken on individual case-to-case basis, because every stocks need to be benchmarked against its fair value. And how do you determine fair value? Is by looking at the financial statements of the company and assess what is the projected future income that the company can generate, and the impact that it will have to a shareholder, right? By virtue of the dividends that they can pay, as well as the increase in stock prices that should be expected. But to a large extent, I could say that it can be both undervalued and overvalued, depending on the assessment of each glove stock. So I can't say that it is necessarily undervalued today. It certainly was undervalued before COVID-19 hit, and certainly we see a significant spike in that, because of course the demand have picked up, but of course demand has reduced significantly, and we should expect that to be the case because vaccination rate increases and across the globe, and therefore less demand for gloves.
Cool. Okay. Avoiding the question, but okay. Let's see. The next question: if I invest in these undervalued assets, when is a reasonable time to ROI? ROI is return on investment.
Yeah. So these are really, really, really big questions. I really liked it. But it's I think that I can give, of course, a straight high-level answers, but I think ultimately it has to be dependent on your investments objectives. So for undervalued assets, typically for the assets to reflect the actual price. So the idea of buying undervalued assets, of course, that you're buying it at a discount. When you're buying at a discount, you expect that the price is going to increase to reflect its actual fair value. And the actual fair value would and sometimes can only be reflected over a longer period of time. For stocks, for example, typically undervalued assets would go up to its reasonable fair price within a short period of time, compared to a property, where the property can take up to 5 to 10 years, for example, to reflect the actual undervalued assets. So it has to be dependent on the assets that you take. But oftentimes, the general answer to this is to make sure that you invest within a long period of time. Right? So that is 5 to 10 years, so that you can see the full realization of the assets from undervalued to a fairly valued assets. And that could take 5 to 10 years, depending on the type of assets.
Right. Okay, cool. I think this might be our last question, one or last two questions, I think. So your slide just now, I think so. This is referring to your previous slide just now. You mentioned that ASN funds are a great place to place your emergency funds. So this question obviously will refer to for the non-boomies. Where can I put my emergency fund? Because for their allocations, it's not always easy to get ASM.
Yeah, yeah. So there are, fortunately, some improvements that we should expect from ASMB soon. One is the ability to open an account on the app using with electronic KYC process. So this is something that you should expect over the next couple of months. We would see that coming up very soon, and thankfully we have the access and know that this is going to come soon. So one way in which you are able to do that is hopefully via the app. So I would suggest that you consider that once the app is launched with the eKYC features. So you can maybe try to look and try to get access to SM first, if possible. Alternatively, there are three other types of assets that you can consider for the purpose of emergency fund. So one is what is called a money market fund, where the return is slightly higher than the FD with very high level of liquidity. Right? And typically, they invest into a short-term assets that can give you a liquid return, but may not give you as high of a return as ASM. Second is to potentially consider a bond fund. So a bond fund is also a type of fund that you can use to put for the purpose of emergency, which are expected to have a slightly higher return than your money market fund, but may have to compromise on the liquidity part. So it may take a couple of days for you to be able to withdraw as opposed to 1 day. And the third, and I think I would encourage that everyone consider this, is to actually top up your flexi mortgage loan. Right? You could actually place further deposits into your mortgage and actually effectively save on the interest that you would pay to the mortgage, right? So that is depending on the interest that you're paying for the mortgage, which is 3 to 3.5% or 4%. So effectively, you're generating a return of that same level and be able to use that money when you need it in case of emergency, right? So that those are the three other areas.
Right.
You look at.
Right. That's definitely something that not a lot of people will have heard from. So again, this is proving to be pretty good advice. Yeah. Thanks, Azril. Yeah. Before I go there, there's actually something else that we should add out as well. So Ringer Plus, we at our blog, we do actually put in a month. We update our article pretty regularly. If you still want to put in FDs, we have a best fixed deposit promos every month, and we also have an article where we share the best high interest savings accounts, right? So there are quite a few in Malaysia. They give about 2.5 up to 2.5%. Some go above 4, but you have a lot of conditions that come with it. So that's something else that we can add into. But I think the flexi loan is flexi mortgage loan is going to be a lot higher returns than that. Okay, so I think this is our last question. Do you consider savings and emergency funds different? Okay, so do you consider savings and emergency funds as different pools? And if so, how do you manage them?
It's a good question, and I think I would like to expand on the buckets that I mentioned earlier. So I mentioned earlier there are two buckets, right? One is the buckets for emergency fund that you would use for short-term goals, as well as the ability to use it in case of emergency. Another is the growth buckets where you can look at investing for a long term and therefore generate higher return. Another bucket is actually the savings bucket, which is the buckets that you can use for daily purposes. And the saving buckets does not have to be high, depending on your expenses. So if you are spend, for example, 5,000 a month, you don't necessarily need to have 50 to 100,000 in those savings, right? And therefore, you should look at maybe having up to 3 months of your savings. So you can place maybe 15,000 in that cash, because these cash are not going to be able to generate much return effectively, right? So then the bucket in which you can put the emergency fund will be the ASMB funds that I said earlier, and those beyond ASMB funds that we've covered earlier, the 4 other options, even the one that Pang mentioned as well in terms of the savings account with high return, right? So we can use that for the purpose of emergency, so that at least you are not going to be putting your emergency into a savings, yes, it gives you a high liquidity, but you would be not generating sufficient return to beat inflation, right? And that can be significant over time. So if you, for example, have 100,000 in savings account, if you think 3% inflation rate is not high, try keeping it for 30 years. The 100,000 that you have at the start of the year would be equivalent to only 60% of the value, which is around, 40% or 60% decline in value over a period of 30 years because of compounding interest. So really, you may be thinking the amount is small, but over time, it can be very, very, very substantial. Right? So therefore, you should look at something that gives at least a return that is above inflation.
All right. Okay, cool. So that's a really lengthy explanation, a lot of details, a lot of info. I know, Azril, that's your style. So unfortunately, I have to cut the session short. We're running a little bit low on time. Our producer's also kind of telling us, kind of speed it up. But really, thanks so much, Azril, for sharing all these insights. A lot of interesting and useful advice and a lot of tips as well. So for everyone who want to speak to Azril more, he's one of our CFPs with Ringgit Plus Advance, and Ringgit Plus Advance is our financial planning service. We are offering licensed financial planners at some of the best rates that you can find in the country. And as you can see, Azril is like top of his game, and so are our other CFPs who are attached with Ringgit Plus Advance. So if you guys want to find out more, just you can scan the QR code, or you can just head on to just Google Ringgit Plus Advance. You should be able to find us there as well. So we'll continue with our sharing sessions. Yeah, just saw a message there. Yeah, love you, Ringgit Plus and Azril. Oh, got a fan there. But yeah, definitely we will definitely be having more of Azril as well as our other CFPs in this session. So we'll come back next week with a new topic and hopefully with more sessions like this in the coming weeks. So sorry that we can't answer all of the questions. I know there's quite a few more. We will try and answer them. Just drop us either a message on this video or even on the Ringgit Plus blog. The guys here also read a blog and they do reply sometimes. So yes, thank you, Azril, for joining us in this session. We'll catch you everyone else next week. Until then, stay safe.
Thank you. Have a good evening, everyone.